So, welcome back. A division of the Securities and Exchange Commission here in the United States has put forth some interesting comments on staking activities when it comes to crypto. And I want to share them with you because staking is not only an important piece to blockchain development, blockchain activity in general, but in my opinion, it's also the best way to make passive income in the crypto space safely without worrying about the volatility and without worrying about the community drama and everything else. But let's get into the comments here. It says the division's position is that these specific protocol staking activities do not involve the offer and sale of securities, meaning participants do not need to register with the commission. This view applies to staking covered crypto assets, the actions of third-party service providers or exchanges, and the provision of ancillary services. The statement discusses protocol staking, where node operators stake crypto assets to validate blocks and earn rewards. It outlines various staking types, including self-staking, self-custodial staking with third parties, and custodial arrangements. Now, here's the caveat here. This comes from the Division of Corporation Finance's staff. Their statement clarifies, but it does not hold full legal authority like SEC rules or court decisions. As a matter of fact, one of the SEC commissioners currently, Carolyn Crenshaw, argued the analysis misrepresents the law and asserts that some staking as a service providers meet the Howey test due to their entrepreneurial efforts. So, the SEC in this staking situation, the Howey test, I remember that from the whole Ripple SEC case. That's where I first learned what a Howey test even was. This is when I first learned what securities laws were. And to me, it all boils down to substance, not form. This is what I kept hearing when I was not covering or reporting on the case, because back then I was not a lawyer. I had no legal background, so I wasn't finna come on here and make myself look foolish. But I am a student for sure. So I spent a lot of time reading, studying, listening to different sources of information. A security is any type of asset that you invest in with the expectation of making money. Yes, that's they may say that that's a broad definition, catch all, right? But it seems to be pretty straightforward to me. With that, there are regulated places where we can trade these securities. That was my whole confusion with the Ripple and SEC case was, well, if it is determined a security, doesn't that put it on a market with way more liquidity? Because securities markets are often tailored to accredited investors with a high net worth. This was my thinking. So to the point that Carolyn is trying to get at, where these staking services still would fall under securities under the Howey test, I have to push back just a bit. Because in other cases, like in the sense of a proof of stake network, like the one we covered just a few moments ago, the XDC network, the proof of stake, the staking is an operational mechanism. You can compare it to, okay, it's like this. You have a car, right? And the SEC is saying that your gas pedal is a security because it makes your car go forward. You're pressing it. The only reason you're engaging with your gas pedal is with the expectation that your car is going to go forward. Right? Sounds like a bunch of that's a tight bind, ain't it? Because without pressing the gas pedal, the car essentially doesn't have a purpose. That is what proof of stake networks like Ethereum, XDC, and others are kind of up against, because the staking is part of their consensus. Without consensus, decisions can't be made on chain. So essentially, they can't press the gas to get the car moving. So I think the question is that they're trying to define here is, how do we define the gas pedal? How do we define where the real value driver is? Is it the staking of it? Is it the staking itself? Is it the network and what the network is doing or perhaps promoting? Because that was another word that came up a lot in the documentation. In the substance, not form, is how you're promoting what you're doing. I don't often see proof of stake networks promoting that they're a proof of stake network. You only really see that when you read a white paper or you get to the right section on a blog site. Because the proof of stake is a operational function, there's no need to market it as such. The network would succeed or fail with or without your investment, because the proof of stake function, in order for people to come and build on the network, they have to become a validator. And what validators do are stake assets. So in that particular sense, you can't blame the business for following the protocol, because they're not making the investment with the expectation that the network will do well or the price will go up. They're making the investment so that way they can operate the vehicle. This is just my 2 cents on it, man. Because like I said, staking is the ticket. If you can figure it out, if you can get a good platform, okay, staking, another word for it is DeFi. But when you bring up DeFi, there's also liquidity pools and all of these other things, yield farming and all of that. That stuff can get complicated. I'm talking to the people who've only been here about 5-6 months and still trying to figure this out. There are centralized exchanges, okay? Full transparency, they are centralized. So some other people will tell you, hey, be careful with them centralized ones. But the centralized ones are the ones that are pushing the industry forward. Just with the exception of FTX, but I'm just saying. There are centralized exchanges that you can go there where they can teach you step by step how to stake, why staking is important, and which networks you can stake on. That, to me, doesn't come off as a promotion. It comes off as education. Because again, the staking for a lot of networks is an operational feature. So that is why I like the division's comments on this as opposed to what Ms. Crenshaw is putting forward, because the division recognizes the operational element to staking. Again, if you can't press the gas, the car's not going to move. What's the purpose of having the car? Now, in other news, when it comes to the SEC, guys, because this also blew my mind too over the weekend, and I got to take a sip. I got to take a sip because the SEC has dismissed their lawsuit against Binance. Oh boy, oh my God. Now, The Guardian is framing this as a latest move by the crypto-friendly Trump administration. I dig that. I just find it so funny that they're doing this because, okay, y'all know I'm not the one to get into conspiracy, but I will point out when I think something is weird. The man was accused of securities fraud, money laundering on a massive scale, and he only got 4 months and a $4 billion fine. Okay? This is after he spent months on X posting four. What for, CZ? What for? Regardless, The Guardian reports that a joint stipulation of dismissal signed by lawyers for the SEC, Binance, and its founder Changpeng Zhao was filed in the Washington, D.C. federal court. Its dismissal is with prejudice, meaning the SEC cannot pursue the case again. The SEC said that dismissing the enforcement case was appropriate in the exercise of its discretion as a policy matter. I'm telling you, the way people say things, man, us humans, we are hilarious. What is in the exercise of its discretion as a policy matter? I quoted that from the Guardian's website, by the way, okay, which is another publication where if you scroll down to the bottom right, you see terms and conditions, and you scroll down to section 11.3, they're going to tell you, don't screenshot our website because we coming after you. But in the exercise of its discretion and as a policy matter. What policy? Right? So as I'm reading this, I'm going back to what I keep hearing about. Just show you, the Trump family has held deal talks with Binance following crypto exchange's guilty plea. This was from the Wall Street Journal. March of this year. Representatives of President Trump's family have held talks to take a financial stake in the U.S. arm of crypto exchange Binance, according to the people familiar with the matter. If this happens, Coinbase is going to be shaking in their freaking boots, man. For real. And at the same time, you know, as a nod to the XR people, a bigger Binance in the United States means way more liquidity for XRP. Because like I said in that segment last week, one of the biggest liquidity sources for the XRP ledger, for where the XRP token is traded, is Binance. And you can see the numbers. Binance was getting alongside when the SEC started going after CZ, 2022. Is when this initially began. They started investigating. Why in 2022? Well, after the bull run of 2021, the NFT hysteria, metaverse wave, gaming came back, Super Bowl commercials, all of that. We were rolling, ladies and gentlemen. If you weren't here in 2021, oh man, we made it to SNL. We made it all the way to SNL. It was fun. It was fun. I ain't gonna lie to you. But all while that was going on, Binance went from 183 to almost $700, ladies and gentlemen. Okay. Boy, I wanted some BNB tokens so bad. But the primary reason why it ran so hard was because of the design of its ecosystem. You had the Binance Global Exchange, which was responsible for 85% of total volume in the crypto space. 85%. Okay? Coinbase, Gemini, Kraken, KuCoin at that time. What was another one? FTX. These guys, they weren't competing. They weren't catching up. Okay? Binance was getting ready to make a major move into the United States with Binance US, because at a certain point in time, we had a former US comptroller in the name Brian Brooks, who was sitting as the head of leadership for Binance US. Okay? Binance has the reach and the size to flip this market upside down. Okay, that is why CZ is just so faux. He just faux everywhere, faux up. Like I'm beginning to think he pouring pipes and something. I'm gonna have to I'm gonna check in with CZ. But I just find this story to be so compelling. Point is, the SEC dropped a case against Binance, and now the SEC is reconsidering their stance on staking. This means that we're definitely entering another market, and it also another era of this market. And it also means that the Trump administration got a lot more pull than what we may realize, folks. What we may realize. So at the end of the day, what can we do with this here? Let's hope that the division's comments on staking reaches where it needs to reach. We do have the head of the SEC, Mr. Paul Atkins, who was very crypto friendly. Look, I was making some content. I believe it was this episode. I was preparing this episode. I have a screenshot, and I didn't bring it up here because I couldn't remember where the heck it came from, but it has Paul Atkins' name alongside other important names. We stumbled upon him before in past content, and I just can't pull it back. Got to figure it out. But if these comments make it up to him and he agrees with it, the staking market, the rates that we're seeing now, that's chump change. We could be looking at 10 to 15, maybe 20% in some places. And this time it'll be verified, backed, and regulated, secured. And with the way that stablecoins are making their way through the space now and gaining prominence, I see staking and stables becoming very kindred spirits during this run.